Okay, let's go ahead and get going with the second part of this chapter 3 set of videos. Now, I've kind of recreated where we ended last time. We created the sort of the chart here, and I just wanted to remind that we have a new transaction that we're looking at. And that is the adjusting journal entry. And it happens at the end of the period. And why does it take place? Well, two things. Because we've got these two principles. We record revenue when it's earned, record expenses when they're incurred, and that comes about because of the passage of time. So let's keep a couple of these things in mind as we start to look at examples and some, because it's not as easy to define them as it is to just go ahead and give examples of these. So we've got cash before, which are oh boy, I did it again. These are deferrals. I don't know why I've done that twice in a row now. And these are accruals. You notice the accrued revenues. So accrued means that the revenue and expense happens first and the cash happens afterwards. Deferral means the cash happens first and the revenue or expense happens second. Okay, so let's go ahead and take a look at, I'm going to be doing some examples, not the exact numbers, but I'm going to be using some of the examples from the homework problems. So let's take an unearned revenue first. An unearned revenue is where the cash happens before we can record the revenue. Now you may ask yourself, well, what is a situation like this? So this particular example is not in the homework, but it's an example that I use quite often. And I will abbreviate unearned revenue as unrev. Now, unearned revenue, for example, let's say you are a game company and you're going to release a game at Christmas, but you go ahead and take a bunch of pre-orders, right? That's very common, game pre-orders. And if you pre-order it, a lot of times you get some goodies with it, some digital goodies. Now, when the game company receives the cash, they say, thank you very much. But can they record revenue at that point? The answer is no, because they can only record revenue when they've earned the cash. Well, how do they earn the cash from selling the game? Well, they earn the cash when they release it at Christmas, because then they have actually provided the goods to the customer. Up to this point at the pre-order, all they've done is taken the cash. In other words, the customer has done their part of it, part of the transaction, but the game company hasn't done theirs. So not until the game company releases the game to the customer for the cash they spent can the company actually record revenue. So here, a good example is sort of a game pre-order. The game gets the cash beforehand, but does not record the revenue until it releases the game at Christmas. So let's take another example that's more of a business example of unearned revenue. So here's sort of rent. And we're going to be looking at rent from the landlord's point of view. In other words, rent revenue. So the landlord is going to rent something. Let's say it's an office space for $1,000 a month. And they say the new tenant, because they maybe don't have good credit history, or just because they have to pay 3 months in advance. Or $3,000. So and let's say this happens January 1st. So let's say we're the landlord, we rent out the space on January 1st, and we receive cash, where we receive $3,000 worth of cash for $3,000. And so we have the money, but think about it in the same way as the game people. The game people received the money before they gave them the game. Well, here we've received the cash, but what is the thing that we need to do as the landlord to earn that money? Well, we basically need to let the tenant work there or lease the space for a month. In other words, we need passage of time to happen. And remember, I said almost all of these are based upon passage of time. So until that point, we have to stick this cash in an account saying, well, we haven't earned this revenue yet. And of course, that is unearned revenue. So we receive the cash. And so now we've got this. Now think about this. Oops. Is this going to be a liability or an asset? Well, once we receive the cash, don't we have an obligation to allow the tenant to be there for 3 months? Well, an obligation is a liability, and a liability is created with a credit. So we've got a credit here of unearned revenue. So after a month goes by, well, now we can record revenue because we've allowed the tenant to be there for a full month. So we've earned that revenue. So let's go ahead and credit that rent revenue. But it's just going to be for 1 month, right? And where are we going to take that from? Well, they've already paid us the cash previously. We're going to start transferring it out of the unearned revenue account into revenue. Basically, what we're saying is, of this $3,000, we have now earned $1,000. So how many months left do we have before we can ask them for cash again? Well, we have 2 more months. So we're going to debit the unearned revenue account. So here's a situation where we receive cash before, right? Cash before, then we record revenue second, and therefore, so cash before and then the revenue. So this is a deferral. We have deferred revenue. We receive the cash first and record the revenue second. Okay, now let's take a look at, we're going to look at a number of prepaid expenses. The homework actually has 3 or 4 prepaid expenses. I'm going to try and explain each of them. A prepaid expense. So a prepaid expense is where we pay the cash first, and then later on we record the expense. Pay the cash first, record the expense later. So the first one I'm going to show is, let's say we're a company with where we have to pay up front our business insurance. Now, a lot of times if you own a store or if you own an office, you have a certain amount of business insurance in case one of your employees trips and hurts themselves. You have some sort of, liability insurance. So business insurance, and you typically pay insurance up front, right? Just like you pay your car insurance. So insurance, and let's say it's $100 a month, but we're going to pay up front, we're going to pay the full year, or $1,200 for the year. So on the January 1st, we, the company, are going to credit cash of $1,200. And what do we get for that? Well, we get 12 months worth of insurance coverage, but we haven't used any of the insurance because it's still just January 1st. So we need to stick that amount in an account saying, hey, this is our insurance coverage. And what do we have? What do we call that? We call it prepaid insurance. And prepaid insurance, if we think about this as an account, it is an asset because it is something we own. We own the rights to the insurance. We own the rights to the coverage for the next 12 months. So we're going to put that here as a debit. Now, after the first month has gone by, we're going to say, okay, I have now used up 1 month worth of my insurance coverage, even if we didn't make a claim. So what do we call that? We call using anything up in our normal course of business, we call that an insurance expense. And it'll be just 1 month's worth. So it'll be 100. I guess I didn't put the 1,200 here. And we're going to reduce the prepaid by 100. So the prepaid will go down 100. And how many months do we have left? We have 11 months left. Let's continue on. And I'll just show you that here again, the cash happens first. The cash happens before, and the expense, the insurance expense happens second. So it fits the requirements to be a deferral, a prepaid expense. Okay, Let's look at another prepaid expense, and this one's not as obvious, and it kind of works a little bit differently. So this is a prepaid expense again, and it's going to be for supplies. It's going to be a supplies expense. Now, at some point in the past, we've bought some supplies. And so maybe there is a certain amount in our supplies asset account, because supplies are an asset. Maybe there's $1,000 in this supplies account. And at the end of the month, because we don't count, every time we take a pad of paper or use up a ream of paper in the copier or take some pens, we don't actually try and measure that. We just go at the end of the month and we have the junior accountant go in there and say, count up how much is left over. How much is in the supply closet right now? And so maybe that person goes in and says, I counted how much supplies, and it'll be an estimate, of course, and there is $700 on hand. What do they mean by on hand? That means there's $700 of this $1,000. There's $700 left. So is $700 how much we used, or is that the remaining balance? That's the remaining balance. So what we need to do is determine how much did we use. Well, if we started off with 1,000 and ended up with 700, we had to have used 300. So this is our expense. We used up $300 worth of supplies. So what does that look like as far as a journal entry? At the end of January, we went in and counted, and we said supplies went down by 300. And that's because we used them up. We have a supplies expense. Now notice I don't have the cash happening first. It did. We bought the supplies at some point. We just don't know specifically when. But definitely the expense happens at the end of the month. So this is an example that's used in the homework and is one that I'm explaining here. Okay, let's go on to a couple more. Here is an accrued expense. And this is interest. So when we talk about an accrued expense, we're saying the expense happens first and then the cash happens second. So this is going to be interest on a loan. So the way we're not going to go into in depth on how to calculate interest. I'm going to use sort of the example in the book. The example in the book says we have some sort of loan out there, and let's say the loan is a multi-year loan. Maybe it's a 3-year loan. Now, at the end of the first year, we're not going to pay any of the interest. All of the interest is paid at the end. But remember, whenever we do the financial statements, if we had use of this money from the loan for a certain part, that means for however long we had use of the loan for this year, we're going to have a certain amount of interest expense for this year. So in the example in the homework, it says the amount of interest that we have racked up, that we have accrued for this year is $400, meaning we're not paying it yet, but of the total amount of interest that we pay at the end, $400 is because of this year's use of the loan. And so when we have this, we say at the end of the year, we say, well, we have the loan and we have an interest expense and it's $400. But what happens when we don't pay it yet? Well, we've got a type of an account that says there's an account for cash to be paid later. An account for cash to be paid later. It's a type of accounts payable. But specifically here, we will start to name these according to their general classification. So it's a type of account payable, but specifically here, it'll be an interest payable, meaning we're on the hook for $400 of interest expense, but we haven't paid it yet. So we're going to have this payable saying we will pay it later. And so that's an accrued expense. So we've recorded the expense first, and then later, after the 3 years happens, we'll pay all the cash at once. Let's take another accrued expense. And again, we're just using sort of the general explanation from the homework without going in depth. And this is a wage expense. And the way it is kind of laid out in the homework, it just says, and I'm going to use the exact number, it says there's $900 of wages at year end that we haven't paid yet. So here we have December 31st. We have a wage expense, a debit of a wage expense of 900, and similar to this, we haven't paid it yet. So we need an account for cash that will pay later, a type of payable, a type of accounts payable, and in this case, it is a wage payable. Or sometimes they use wage and salary payable. 900. All we're saying is, because at the end of the year we need to create our financial statements, we want to say, yes, we had people work for us. People working for us is a wage expense, $900. So we need to record that expense, but we haven't paid them yet. So we're going to say, here's an account that says for the $900 that they worked us for, we're going to basically give them an IOU and say, we'll pay you in a little bit. Typically it's because the work week or, the pay period is split by the end of the year. And so the expense happens first, and then later on the cash happens again. And that's the definition of an accrued expense. The expense happens first and the cash happens second. Last one of the four. So we've got an unearned revenue. We've got a prepaid expense. We've got an accrued expense. The last one we need to look at is an accrued revenue. And that is where the revenue happens first, and then the cash happens second or later. And the example in the homework is, they say there's $2,300 of services performed that has not been billed. Well, remember, our revenue recognition policy says we cannot record revenue until we've provided the goods or we've performed the services. In other words, we've done our part of the business transaction. Well, here it says the services were performed. So we could, at the end of the year, if we haven't billed them yet, but we still have done our work, we earned that money in this year, even if we haven't been paid it yet. So we would write a credit to a service revenue of 2,300, and again I let the thing time out. Let's see if it zooms in correctly. Okay, it looks okay. I need to keep jiggling the mouse to keep it going. So we've earned service revenue, and we need an account for cash to receive later. And of course, that's an accounts receivable, 2,300. Okay, so those are the examples and a brief definition of all the four accruals and deferrals. And I want to go ahead and spend the last couple minutes here of looking at another problem in the homework. So I brought it up here, and I've replicated the cash before, cash after, the revenue expense, the chart of the four. And I want to go through and I want to read these. I won't read them all, but I want to kind of teach you how to read these so you understand what's going on. So the thing you want to do is whenever you read these, you want to remember everything is just going to be a revenue or expense. So the first thing you can do is determine, is the thing we're talking about a revenue or is it an expense? And the second thing is, did the cash happen now or did the cash happen later? So let's look at this first one. We collect $1,300 from a customer. Well, that's saying the cash is happening now, right? For services to be performed in 2023. Well, services performed is a revenue, right? So cash, if we go over here, that's going to be the unearned revenue, right? We receive the cash but we haven't performed the services yet. So I'd say that's earned revenue. Luong incurs a utility expense, which is not yet paid in cash or recorded. So the expense happens first and no cash has happened yet. So that looks like cash is going to happen later, right? No cash has happened, and we're going to go ahead and record the expense. So this looks like an accrued expense. Luong's employees worked 3 days in 2022, but will not be paid in 2023. Again, an accrued expense. We've had employees work for us, but we haven't paid them yet. So the expense happened, but we haven't paid them. Luong paid $2,800, I'm looking at number 5 here, in rent on December 1st for the 4 months starting. So we can see right away the cash is being paid. But it's being paid, meaning it's going out. Well, revenue is cash coming in. Expenses are cash going out. So this is a rent expense. So we're recording the cash first, and then we're recording the rent later. So this looks like cash first, and then recording the rent expense later. This looks like it's a prepaid. Number 9, Luong purchased $900 of supplies in 2022 at year end. 400 supplies remain unused. Well, this is very similar to the example that we used, is that this is a prepaid expense again. In other words, we bought the cash. I mean, we bought the supplies, and so we paid the cash up front, cash before, and now we're expensing the supplies at the end. See, I don't think I've done one. I have an accrued expense, a prepaid expense. Let me see if I can find an accrued revenue. Number 7. Luong performed consulting service for a client in December 2022. On December 31st, it did not bill the client for services provided. So we have performed the services, meaning it's a revenue. We can record the revenue. But we're not going to receive the cash until afterwards. So we're going to accrue this revenue. Accrue this revenue, unearned revenue. We're going to accrue this revenue, excuse me. So there's an example of each of all of these. Hopefully you'll be able to work through the rest of them. If you have any questions, let me know. This should hopefully get you through most of the homework. And I will be posting something about the test that's coming up next week. Thank you.